Alright, welcome to Module 3. In this module, our expert will cover a range of alternative sources of capital. So, get ready to take some notes, and let's jump right in.
Module 3. Alternatives. Having a business idea means that your friends and family are going to be the first ones to know about it. After all, they might have spent months or maybe even years listening to you talk about your plans and seeing how you're slowly turning your idea into a reality. Those close to you may want to support your dreams, but it's important to find the balance between professional and personal matters. In this module, you will find a few tips for encouraging capital in a healthy and safe way, as well as finding other alternatives. Gifts. On the onset, generous friends or relatives may offer you a small cash gift to support you from the first few expenses. This can be great and be well appreciated if the intentions are right. Why is that so? Well, once the company becomes successful, people who you thought were giving you wholehearted gifts are now expecting their money to be repaid. To avoid such discussions, it's best to clearly communicate to the other person that whatever amount they give is considered as a gift, not a loan. You can also communicate through writing. When you clear out these issues, you keep things professional. Loans. Friends and family members are less likely to charge you interest than any other source, so this can be a great way to raise money without added expenses. However, it's important to keep in mind that these loans will probably be way smaller than those from banks or investors. Another thing to point out, once you've borrowed money, your personal spending may be under scrutiny while you're in debt. It's best to work with a business attorney or a peer-to-peer lending company so everything is above board and professional. Equity. If you have friends or relatives who believe in your company's potential, they may want to have a share of it. Like selling equity to an investor, this will not work for people who want to retain full control of their company. Before choosing a person, it's best to consider first how working with this person as a business partner might affect your personal relationship. If you decide to sell equity to an individual, make sure to involve a business attorney so everything is official. Crowdfunding. Crowdfunding, from the word itself, is a funding project where you raise money for your business by asking for support from a large number of people or crowd. Crowdfunding has gained popularity in recent years with lending platforms like Kickstarter and Indiegogo that have raised a total of more than $34 billion. When you crowdfund, you publicly raise money. This means that you have to clearly explain the reason why you're raising money. There are 4 types of crowdfunding: donation-based, rewards-based, debt-based, and equity-based. For example, you can use rewards-based crowdfunding and give your backers unique rewards in exchange for their donations, or use equity-based crowdfunding and sell small parts of the company. However you do it, the process is formalized through the crowdfunding platform and will clearly mention that the money donated will not be repaid. So if you're unsure about involving friends and family through other methods, crowdfunding might be the best option for you. Credit card. Credit cards can provide easy money for small business owners. There are 2 types of credit cards: personal and business. Personal credit cards provide better government protection, while business cards provide higher limits and better rewards, such as a discount on office supplies. This can be really beneficial for business owners. Funds through credit cards are easily accessible, which can be very helpful for sudden transactions. Regardless of what credit card you choose, paying your bills on time is paramount. Paying your bills on time means improving your credit score and is beneficial both for the owners and businesses. This also means you can enjoy special rewards and perks such as airline miles, gift cards, and cash back. However, Despite the number of benefits that credit cards provide, they also have serious risks involved. Being unable to pay your bills on time can seriously wreck your personal finances. Another disadvantage is that credit card interest rates are way higher than traditional loans, which can ultimately lead to bigger debt. These pricey arrears can drag your business down during tough times. Conclusion. In reality, turning your business idea into reality isn't easy. Serious funding is involved. You can't think ahead of how prosperous the business can be if you don't have the means to get things started. You need to get that first boost to kick things off. The three main ways you can raise capital are through loans, investors, and friends and family. Small businesses may find it difficult to secure a bank loan, but there are groups like the SBA specifically designed to help companies find capital to make their dreams come true. When it comes to finding investors, each has its own pros and cons. You should first determine what your business needs are. Then choose the right one for you, if it's a venture capitalist or an angel investor. If you decide to seek help from your friends and family in your company's finances, make it clear that their support is solely for business and that there are no blurred lines between your personal and professional life. Lastly, if you want to apply for a credit card, remember that you need to accept serious consequences if you're not able to pay your bills on time. These modules provide a list of practical choices to choose from. Choose the ones that best suit your situation. After all, at the end of the day, it's your business, and only you know what works best for you.